Good morning, everybody. You all think we're a failed state, don't you? Not? Yes? There's lots of negatives around, absolutely. They vary from potholes to not electricity anymore. So that's a positive. So the idea that South Africa is a failed state, I think, is a wrong term. We've got lots of negatives. We're moving in the right direction. Electricity is a good example. At Old Mutual, we look at the environment to see how and where we should invest our clients' monies. That means we need to look towards the medium to longer term. To focus just on today would be wrong, because there are stuff happening that means we could be improving. That environment, I think, is improving, and that's what we'll go through and look at over the next few slides. But also the global economy is important. What happens in the US impacts heavily on South Africa. Recently, we've seen the trade war, we've seen the dollar weakening, and thanks to that, we've seen the rand strengthening. So that's also a question we need to answer. So lots of turmoil, lots of uncertainty. I think the job of an economist is really to look through the noise, to see the bigger picture. What's important to understand about economics, it's not an exact science. At its basic level, it's what you and I think of the stuff around us, the potholes, the lack of water. I hear in Joburg, in Cape Town, we have now water. So it's that impacts on our decisions. We should spend or save or invest. So economics, the study of human behavior. So let's go forward and let's look at the stuff that we're going to talk about. We're going to talk about the US, the impact on the economy from trade tariffs, inflation, what's happening to US interest rates, what's happening to the dollar. We're going to look at the SA economy, especially the medium-term outlook, because as I say, that's where the focus should be. And we're going to talk about the rand, where nobody agrees with me really. Lots of turmoil in the global economy coming from the US president. The trade war has had significant impact. But surprisingly, the global economy is looking relatively resilient. So that's a big positive. The US economy is slowing though. You might have seen the news around lower levels of job creation, concerns about the economy, and thus the Fed restarting to cut interest rates, despite their concern about inflation. So the graph on the left here shows growth in the big areas of the world, the G3 economies, US, Europe, and China. And you can see clearly that economies are still growing in a positive territory, but not as much as they used to grow in the past. So there are concerns. But you can also see that actually China is growing better than Euro area and the US. The graph in the middle shows really a confidence indicator for these three economies. And when it's above 50, it's expansion, stronger growth. And that's surprising that the current situation is actually looking pretty okay, despite these turmoils that we've seen. So the graph on the right here shows inflation, core inflation, excluding food and energy. China's inflation very low, and there was some concern about deflation there. But you can see that the others, Euro area and US especially, it's above their 2% target. So that's why the Fed hasn't been cutting rates earlier this year. They're concerned about inflation. Of course, we know that tariffs lift consumer goods prices. Consumers in the US understand that. So higher consumer inflation. But if the economy slows, then likely less inflationary pressures down the line. And that's what the Fed is now focusing on. If we look at the outlook for the global economy, this is a result of a survey done by chief economists that's linked to the World Economic Forum. So asking these group of chief economists, what do you think about the outlook for the global economy? You can see the yellowish numbers are, and the gray numbers sort of weak, moderate to weak. The blue numbers are strong. And you can see at the top areas, the Middle East, North Africa, South Asia, East Asia, Latin America, all those economies have got more blue in that number. So the balance of opinion amongst this group of chief economists that those economies will do far better. But then looking at the bottom, there's more yellow in those respondents' numbers. Weaker growth expected in the US and the Euro area. And that's what's starting to filter through into market indicators like the US dollar. And what do people think, these chief economists think about what's happening in terms of the trade impact, the top part shows the dark blue that they think the disruption will be significant. Significant disruption because of trade tariffs. And you've seen the news flow around that. The trade tariffs imposed by the US on other countries, but those countries are trying to find alternative routes for their exports. And the bottom part shows what the group of chief economists think, how long will this impact be? And they think that this impact will be relatively long. I differ somewhat. I think outside of the US, where countries are looking for other export destinations, free trade is actually booming outside of the US. And think about it. Those of you who look at car prices, for instance, in South Africa, the cheap car imports coming from China and India, more and more people in South Africa are buying those cheaper imports. The same with US consumers. Eventually, they will get fed up with these high prices for imported cars, TVs, fridges, washing machines, and they will demand cheaper prices again. Consumers are voters. I don't think the disruption will be that long. Voters in the US will eventually allow this to turn around again. So strong free trade outside of the US, and eventually the US will return to that. Because we know that the president won't be around for forever. It's got a limited term. So there's strong growth in lots of areas of the world, weaker growth in the US, and significant disruption seen, but I think that the disruption won't last long. Now the graph on the left here shows an index of leading indicators in the US, and very simply, it's a bunch of economic indicators compiled into one index. It's been declining since January 22 in this latest cycle. But you can clearly see that in previous cycles, when that line has been coming off, it headed into those vertical gray bars, recession in the US. That looks very similar to previous recession periods. Now again, the point that economics is not an exact science. So I can't tell you for sure that a recession is definitely coming. What I can say is that it looks like there's weaker growth coming. And if we add on top of that the policy uncertainty that's building in the US, consumers and businesses, they don't want to make big spending decisions when they're not sure about the future of policy. So consumers say, hang on, I'll wait till I know what's happening before I buy a new car, before I buy a new TV, before I buy a bigger house. Similarly, businesses decide, I'm not going to employ more people. Incidentally, we're seeing that in the labor market. I'm not going to build a new factory. I'm not going to invest because policy in the US is uncertain. So uncertain policy, on top of a weakening growth, can very well push the economy in the US towards recession. Now, unfortunately, in economics, we also work with data that's lagging. We wait a long time for the data to eventually come out. So by the time the National Bureau of Economic Research in the US might declare a recession in the US, it might long be over. That's the past history that we've seen around these things. The graph on the right shows that US inflation is still above target. But the Fed is thinking, slowing economy, weaker labor market, significantly weaker already. It's still on a net basis positive, but far slower job growth than what we've seen over the last 2 years. So that has an impact in terms of consumer spending ability. The Fed is thinking that weaker economy will mean less pressure on inflation. So they're happy to start protecting the economy by cutting interest rates. That's what we've seen in September. My view is that there's going to be a successive series of 25 basis point rate cuts until the middle of next year, between 100, 125, maybe even 150 basis points of rate cuts. That's important to keep in mind when we think about the prospects for the dollar. There's concern in the US about this. You might recall the wording around this fiscal package. President Trump called it the One Big Beautiful Budget Bill Act, mouthful. It means that the budget deficit over the next few years will be significantly higher. The green line on the graph already shows the budget deficit bigger than 6%. It's going to be bigger and bigger over the next few years. Their debt ratio sits at 120%. By the way, our own is only 78%. Much higher deficit ratio there. That's going to drive up towards 130 over the next 5 to 6 years because of that extra spending coming through that act. So investors are now concerned about the fiscal situation on top of lower interest rates over the next while. But think about it. the pressure from the US administration on the independence of the Fed. President Trump wanting to fire Lisa Cook, one of the governors, wanting Jerome Powell to go. That's unprecedented, impacting investor sentiment. The fact that the president fired the commissioner of the Bureau of Labor Stats, who compiled the labor numbers and the CPI numbers. Let's face it, not even President Zuma tried to do that with a stats SA head in South Africa. That's unprecedented. So you've put all these things together, uncertain policy making, pressure of the US administration on independent government institutions, supposedly independent, then investors are becoming more and more concerned, thinking that, hang on, is the US still that safe haven investment destination? And that's why the dollar is weakening. The graph on the right shows clearly the dollar has weakened quite a bit. I think it can weaken further. Now, weaker dollar, always good for emerging market currencies, always good for the rand. So this is good, this background. Global economy relatively resilient. Weaker US growth will mean more interest rate cuts. Concerns about the US will mean weaker dollar. So if we move forward and we talk about the SA outlook, I said earlier we shouldn't focus too much on the short-term picture, but we should also take that into account. So we know that graph on the left, the bar shows the quarterly annualized GDP growth numbers. First point is very weak. Second point is very volatile. First quarter was very dismal, just a slight positive. There was a huge recovery into the second quarter. That was a pretty easy forecast to make because the high-frequency numbers, if you look at the second graph on that slide, mining, manufacturing, electricity production, that was pretty weak in the first quarter, they all rebounded. We had high-frequency data available through the quarter. So we saw that rebound, the last bar on the left-hand graph, in terms of second quarter growth. Media and some analysts got very excited about that, but that's just a rebound from a weak first quarter. On average, the red line shows it's still pretty weak. That's the important part. Now we know that we're going to have an impact, some impact from US tariffs on us, but perhaps important to stop there for a minute and just think about that. If we exclude precious metals exports, less than 5% of our exports go to the US. So it's not a scenario where you should expect a significant recession in South Africa because of trade tariffs. And it seems that there's some deal on the way, so maybe our trade tariffs on that less than 5% of our exports won't be 30%. Specific industries impacted, as you know, motor industry, wine exports, citrus exports. But let's face it, that 5% or less than 5%, it's not going to collapse to zero overnight. That rich US consumer of South African wine, let's say, simple example, he used to buy 10 bottles of $20 wine per year. Now the price goes up a little bit. Now he buys 5 or 6 bottles. He's still going to buy some. It's a volume impact. There will be an impact, but remember it's less than 5% of our total exports. Also, along the line, some other people take a bit of a price pressure. Exporters from South Africa might take a little bit of a margin off, trying to protect their volumes. Importers in the US, wholesalers in the US, they also take a little bit of a knock. Not all of the price impact will go through to the final consumer. But look at consumers. That's you and me. We're all consumers. The graph on the right shows retail sales spending and car sales spending. That's a significant upturn from early last year already. Now, early last year, we still had significant load shedding, stage 6 virtually every day in the first quarter of last year. It was before the elections, it was before inflation started falling, it was before the rate cuts came, it was before, I hope you didn't access your pension fund money through the two-pot system, but before that became available. So consumers have actually been booming, and certainly that has been further assisted by that much lower inflation, lower interest rates, etc. But we like to complain. There's no good correlation with the actual consumer confidence numbers versus that spending picture. We spend, but we still complain. Is that true? So look at inflation, and I know that's probably my favorite topic, but Africa, just watch if they start throwing tomatoes or rotten eggs. Inflation in South Africa is an absolutely perfect number. The methodology the collection of prices, the calculation of that. But remember, the inflation number that you see, that's not your or my inflation number. We all spend our money differently. So it's the average of 64 million individual inflation rates in this country. Because we spend our money differently. My basket might be skewed towards whiskey, yours might be skewed to another sin or other things like education costs. So it depends. The number is absolutely accurate. Look at the dark green line. It's actually been a great performance of inflation, moving sideways around the 3 to 6% target band. And if you look at the picture where the light green line shows significant weakening in the rand exchange rate from 2011 onwards, actually, inflation has been performing well. Why? So yes, the Reserve Bank has been doing a great job, and I hope Lesetja Ganyago isn't here. But fortunately for them, the economy was weak. That meant it was difficult for businesses to pass on those cost increases coming from a weak exchange rate. In previous cycles, when the rand weakened, inflation went up. Much easier to pass on those cost increases when the economy is doing better. But in a weak economy, companies wanted to protect their margins. Sorry, their volumes, but the margins came under pressure. Now look at that graph and think about the new adjustment of the Reserve Bank to now target the bottom end of the range, 3%. The official range is still 3 to 6, but they've decided to go for 3. Absolutely fantastic, using that window of opportunity while inflation was low. If you look at that graph from 2011 onwards to about 2015, you can see clearly that when Jill Marcus was governor of the Reserve Bank, she and her MPC targeted 6%, so inflation roughly around 6. Then from 2017 onwards, Reserve Bank and Lesetja Ganyago targeted the midpoint, 4.5, and you can see inflation roughly around that. Of course, there were cycles. Think about the COVID cycle, the unlocking, the supply chain issues, the Ukrainian war impact on food and energy prices, but then inflation came back. Reserve Bank now targeted 3%. Fantastic. Why? Because when inflation is lower on a sustainable basis, it just benefits you and me as consumers. Prices rises at a lower pace. And that will mean interest rates will trend down and be lower over time. Fantastic. Now, what we need to do is we need to get Treasury to officially change the target as well, from the range to the 3. Because the graph on the right shows at the top line, that's public sector inflation. That's still 7%. That's education costs, municipal rates and taxes, water tariffs, electricity costs, etc. So everything that's set by a regulator or government department. So if they don't come to the party, it's going to be so much more difficult to get total inflation at the midpoint or at 3%. The bottom line shows consumer goods inflation. That's clothing, shoes, furniture, appliances, vehicles. That's less than 1% on a year-on-year basis. And again, I trust these numbers. What it means, if public sector inflation is there, the Reserve Bank have to, essentially by keeping interest rates higher for longer, kill the consumer to get consumer inflation down there so that the average is at 3. So government needs to come to the party. That's important. I think that will happen pretty soon. Just briefly, that's the disaggregation of that consumer goods inflation I showed on the previous graph on the right at the bottom. There you can see how vehicle inflation has been coming off, clothing and footwear inflation. But look at furniture and appliances. Deeply negative. And usually people don't believe me, and then I show them the actual numbers, all 391 components of the CPI basket. There are lots of price declines on a monthly basis. Stuff like electronics, cell phones, computers, laptops. That's all negative on a month-on-month basis, and on a year-on-year basis continually. Prices of computers are just falling and falling and falling. Also, many of my own colleagues still say things like health inflation is still about 8 or 9 or 10 or 12%. No, this inflation targeting regime has forced all those other inflation rates lower. They're not yet where they should be, but they've come off from the high numbers. Shows you inflation targeting is working. And now we're moving from 4.5 to 3. That's beneficial to all of us. Food inflation is okay, I'll skip that, but inflation is going to drift up. This is my forecast, but it's probably going to stay below 4.5%, and this updrift is moderate. It's just base effects, a normal cycle, nothing to be too concerned about. So that highlights the point that the Reserve Bank had a window of opportunity to go for the lower target while inflation was low. Would have been more difficult if they waited till the end of the year. Because fortunately, inflation expectations have also been coming down as actual inflation came down. Important there, what unions think of inflation. If their expectations come down, it means their wage demands will be lower. That's a key part of keeping inflation under control. So the Reserve Bank has done a lot in terms of this, but look at the graph on the left. The red line is what their January forecast was for inflation. They lowered that significantly to July, but recently have to move it up. I think I disagree with them in terms of some of the forecast if you look at the two tables to the right. My forecast versus the Reserve Bank's forecast. I think they're getting to lower inflation too quickly. And again, I hope Lesetja isn't here, but I think there's some kind of public relations exercise here, trying to convince us of the benefits. If you see lower inflation, you can see lower interest rates. I think we will hit there. I think it'll take a little bit longer than what they think. As you can see, eventually I also see rate cuts. For now, I think interest rates in South Africa will remain flat, sideways, and then perhaps we see cuts again from 2027 onwards, in line with lower inflation. So that's fantastic. At least we don't need to see a hike. There is a small probability that we could see cut soon. If the rand keeps on strengthening, oil prices are actually coming off a little bit, so petrol prices might decline. That will be a better inflation outlook, and perhaps the Reserve Bank use that opportunity. More important is the medium-term outlook. Look at economic growth in South Africa. From strong growth in the 50s and 60s, downtrend through the 70s and the 80s, and of course you remember the sanction period. Isolation, growth collapsed. Brief uptick in 1980 when the gold price moved up significantly. The SA economy was then far more exposed to gold in terms of share of the economy, share of exports, share of employment, etc. But it came right back because you can't build an economy on one commodity. Then we had the mid-90s, new government, better policies, confidence returning, growth picked up quite a bit. In fact, some of those policies were fantastic. I reckon you're all too young to remember, but in the late 90s, government cut import tariffs significantly on the stuff that you don't use anymore, but I did back then. Video machines, CD players, DVD players, prices collapsed. Consumers were happy. Of course, that's the opposite of what Trump is doing in the US now. Raise tariffs, prices are going up. So good policies, better growth. Above 5% at one stage. Then came the global financial crisis, and then, I'm going to say it, then came the Zuma years. Confidence collapsed, growth collapsed, and that's a pretty bad picture. And it had significant impacts in terms of unemployment. The graph here shows in the green shaded period, strong growth, we got the unemployment rate down. Weak growth and the unemployment rate shot up. Makes sense. And this graph here shows the bigger impact in terms of investor sentiment. The impact on the fiscal side, the budget, the debt ratio. Strong growth, budget deficit lower and lower and lower, and you got the debt ratio down. Think about it, your own household finances. If you run a surplus on your monthly incomes and expenditures, you repay debt. Now again, Old Mutual's chairman, Trevor Manuel, I keep on telling him that, you did a great job as Minister of Finance during that period, but you had a strong economy behind you. That meant significant growth in tax incomes. That helped him. But the debt ratio, we got to below 25% at one stage. Then came weaker growth, budget deficit exploded, debt went up towards 78%, lower than the US 220 at the moment. The big issue there is not that it's 78%, but that it's 78% while the economy was growing only at 1%. Had the economy been growing at 3%, it wouldn't have been an issue. So during that uptrend, we lost our investment-grade credit ratings. So we need to get growth up. Then we can make some impact in terms of unemployment. Then we can fix the budget situation. Now, over the past 16 years, as you saw in those previous slides, we had an average growth of 1.1%. That's nothing. close to zero as you can get. No wonder we had those impacts in terms of employment, in terms of the fiscal situation. But I think there's some of those better policies that can drive growth back towards 2.5% to 3%. It's not going to be today or next year, but over the next few years. Why? Because we're making significant inroads in those structural constraints that we had in the economy. Think about electricity. That's the private sector that solved it. Yes, Eskom has also improved, but think about all those solar farms and wind farms that have been built. So allowing the private sector this bigger role in the economy by sorting out stuff where state-owned departments have essentially failed, that helps significantly. So we've solved almost the electricity crisis. Now we see the private sector getting involved in Transnet's operations. You would have seen the news flow around that. Private companies being allowed to run their own trains on Transnet's railways. Private sector is getting involved in building the electricity grid. Operation Vulindlela, Treasury, doing a lot to ease the regulations to make it easier for the private sector to invest, get involved. So there's lots of that will help. Of course, in the short term, the cyclical side, the lower inflation, lower interest rates also help. But sorting out those structural issues, the bigger role of the private sector, that's going to get us from 1.1 towards 2.5 to 3. Now, the important point is that's not enough yet. We know that. But it's 3 times what we had. So it will start to make an impact in terms of confidence, in terms of profitability, in terms of employment, those circular effects in the economy. But unfortunately, I don't think we will ever get to the 5 or 6% that we actually need. And my view is, apart from all the negatives that you're still thinking about, apart from still slow policy making, still slow policy implementation, labor market. We've got a lack of skills in South Africa. We haven't done anything about the education system over the last 30 years. Minister, that's my view. So we haven't built the skills that we need. We're doing some things at the margin by allowing, through visa regulations, some skills coming in, but the big skills we don't have. And the labor market is too regulated. If we had a fully deregulated labor market, then private sector employers would have employed more when companies are doing better, when growth is doing better. But when the perception is that labor is militant, expensive, and unskilled, companies use technology, machinery, equipment. So we need that. So we can get from 1% towards 2.5 to 3, but never 5 or 6. If you look at this graph, this is key. Confidence drives growth. So the orange line is economic growth. The red line is a survey that's done by the Bureau of Economic Research at Stellenbosch University, asking companies, are you concerned about politicians and their ability to make the right policies? When that red line is low in that first green shaded period, around 2004, 5, 6, 7, 8, it means they had little concern, which of course means they had strong confidence in the politicians, in the policymakers. That was incidentally the period when Thabo Mbeki was president, when Trevor Manuel was Minister of Finance, and the late Tito Mboweni, governor of the central bank. Strong growth, thanks to strong confidence. Then came the global financial crisis, and then came the Zuma years, and that concern moved up dramatically, and growth collapsed. The Reserve Bank's study showed that instead of 1.1% growth could have been above 2%, close to 2.5%. Had that red line continued in that low period. In other words, had confidence continually been strong, growth could have been significantly higher, almost double. Of course, we had some impacts in terms of that. Confidence started improving after the elections last year, but confidence also started deteriorating earlier this year because of the uncertainty around the budgets. But the problem is that essentially, in the Ramaphosa presidency, confidence has remained weak, or that concern has remained high. I think we've become disillusioned around these policy changes because we have seen positive policy change. If you think about July 21, for instance, when there were the unrest in KZN, there were lots of concern that policy could shift to the left. Let me pause there for a moment. My left, probably socialism. My right, pure capitalism. We've always been sort of in the middle, decent government regulation, decent private sector participation. Incidentally, we've always been better than countries like France or UK in terms of their social security systems. They've been slightly to the left of us. So back in those unrest period, there were concerns amongst many analysts that policy will shift slightly to the left, which simply means governments spend a lot of money on the population to pacify us. But we didn't have the money. The budget was already constrained, debt levels were already high. So we didn't do that. We shifted policy slightly to the right. This bigger role of the private sector. And actually, the government should get the credit for doing that, allowing the private sector a bigger role. That's sorting out the structural constraints, the electricity, the water, the electricity grid, the transport, logistics, etc. And yes, it's slow, but it's happening. So I believe that government didn't really get the credit they deserve for allowing that. Incidentally, lots of people would then say to me, Johann, stop there. They could have done that thing, shift to the left. I think it's positive that we didn't. Countries like, as an example, Argentina and Turkey probably would have done that. Spend more money, blow the budget, debt levels go up, foreign investors run away, currency collapse. It's positive that we went the other way. No, we're not a failed state. Despite all those negatives, we know there's lots of corruption in South Africa. So I'm not going to argue that there's not. But what foreign investors do, they compare us with other similar countries. So what I'm doing on this slide, with 3 components, I'm going to compare us with countries like Argentina, Mexico, Brazil, Turkey. Russia's on the slide, but nobody invests there anymore. For comparison's sake, I've got China and India, the 2 big emerging markets on there. Also the 2 best in Africa, Mauritius and Botswana. And of course, the worst in Africa, Zimbabwe, to show you that no, we're not a Zimbabwe. No, we're not on our way to become a Zimbabwe. So we've got lots of corruption, but we're not the worst in the world. We're the thick blue line on that slide. The best at the top, Mauritius and Botswana. The worst at the bottom, Zimbabwe. And this is World Bank data, by the way, totally comparable. Same methodology used across the countries. So, yes, we have got corruption. No, we're not the worst. Perhaps we're not the best, but we stand out relative to our competitors. And in an environment where global investors are worried about the US as an investment destination, perhaps not that safe haven anymore, they start to look at emerging markets at slightly better returns because growth is better. They can look at us and say, hang on, South Africa's got corruption, but they're not Argentina, they're not Turkey, they're not Brazil, they're not Mexico. They're better than India. They're far away from Zimbabwe. For an economist, that relative, that perspective is important. The next slide shows a fragile state index compiled by the Fund for Peace. Now, in this case, it's opposite way. The worst one, Zimbabwe, the light gray line is at the top. The best, Mauritius and Botswana, at the bottom. We're not a failed state. We're better than our competitors. Yes, we're not the best on the slide, but we're better than our competitors. Where state-owned enterprises and government might have been failing, the private sector makes up for a lot of that. And just as one example, the media in South Africa, in this universe of countries, by far the freest. We're at the top there, the best. That is fantastic. The media highlights all the negatives, highlights all the corruption. Absolutely fantastic. Unfortunately, in my view, some of the media just focuses on the negatives. And if consumers only read social media, they will only see the negatives. There are emerging positives out there. This private sector role in the economy. It's not all negative. For instance, when I read an article about why the rand is weak, it's not now, but some time ago when the rand was weak, and the whole article just lists all the negatives in South Africa, whether that's potholes or electricity or politics or GNU issues or whatever, but there's only essay negatives in the article explaining why the rand is weak, and there's not a mention of the US dollar. The article isn't worth the paper it's written on. The bulk of the valuation of the rand comes from the US dollar. So the media does a great job, but some of them focus only on the negatives. Perspective again. Our debt to GDP ratio, the green line, peaking at 78% of GDP. It's going to come down over the next few years. But the perspective is, back in October 2020, the expectation and the forecast was the red line that it will go to 95% of GDP. It didn't. Better outcome. Earlier this year, before budget number 1, you know there were 3, before budget number 1, lots of investors worried that government might spend a lot of money on bailing out Eskom and Transnet and municipalities. They didn't. Fantastic. I just did the rough calculation. Had they spent 200 billion over the next few years, the red line would have been the result. Again, the perspective, it's better. But also the ratings agencies are behind the curve, in my opinion. That shows Moody's and S&P and Fitch ratings. Yes, we're not in investment grade. But at the time when, for instance, Moody's assigned that BA2 rating, they said the debt to GDP ratio will go to 110% by 24. It's nowhere near there. Fitch said the debt to GDP ratio will go to 95% 3 years ago. It's not close to that. The point is, ratings agencies are behind the curve. When you see somewhat better growth, when you see some improvement in the government finances, then they should adjust their ratings. So I think Moody's and Fitch will soon also change their outlook statement from stable to positive, where S&P is. So I think within a few years, we can actually see some upgrades. Within 4 to 5 years, we can actually be back in investment grade. So what I'm telling you here is, despite all the negatives still around in South Africa, I think we've halted the downtrend. We're stabilizing, and we can see the prospects improving over the next few years. And that's the important point here. But allow me to stop with my favorite graph. I know I am a nerd, but I love this graph. What it is, the rand valuation. So the green line is the actual rand-dollar exchange rate versus the blue line, which is the theoretical valuation. And that's simply inflation differentials. Fancy economists want to call it the PPP, or purchasing power parity line. When the green line is above the blue line, it means the rand is much weaker than what it's supposed to be. There's a couple of interesting stories on that slide. For instance, back in 1980, I mentioned previously, when the gold price went up significantly, the rand actually strengthened much more than it was supposed to. Then, again, you're all too young to remember, there was a previous president. They called him in Afrikaans die groot krokodil. All forgotten, fortunately. P.W. Botha, the Rubicon speech in the mid-1980s, promised reforms, didn't deliver. This happened in Durban. Markets disappointed. The rand collapsed. Now, if the rand were to move now to the same percentage change as it did in the mid-80s, the rand would actually be 54 to the dollar. It's not. So we're not the basket case you thought we were. Of course, in December 2001, the rand weakened substantially, and everybody in his dark forecast that the rand will keep on weakening. It didn't. Unfortunately, lots of people took all their money offshore, and it took till October 2015 before the rand came back to that previous valuation. Lots of people were crying because of the offshore investments. Now the rand is much weaker again compared to the fundamental valuation. You can see that in the early 2000s, the rand has often come back to that valuation. I don't think the rand will come back to that now. That last data point on the blue line is 1154. I don't think we're going to see that. But the rand can strengthen significantly. And the recent example is exactly, there's a short-term graph of exactly the same one on the left. In April 2020, in the lockdown, the rand went to 1990 to the dollar. The easy forecast, the rand will strengthen significantly. The difficult part, because economics is not an exact science, was when and where to. In the event, it went from that 1990 to 1350, just 15 months later, June 21. From 1990 to 1350. How quickly we forgot about that. Now the rand can similarly strengthen significantly. I don't think we're going back to 1350, But the rand has strengthened quite a bit over the past few weeks. I think the rand can easily go back towards a 16 handle. When I say handle, I just mean anything between 16.00 and 16.99. I'm not cleverer than that, so I don't know exactly where, we don't know. But the rand can strengthen significantly. It can even have a 15 or 14 handle. And then it will drift again. But think about this whole story that I sketched. Better medium-term growth, easier to fix the budget, ratings upgrades, and then lowering of the inflation target. So instead of a 2.5% margin, us at 4.5%, the US at 2%, we're lowering that margin to 1%, us at 3% and the US at 2%. So lower margin, lower differential between inflation numbers means the rand can be more stable down the line as well. So on a very simple basis, bringing that all together towards investments, I think South African individual investors should be more like a US individual investor. The bulk of your investment should be in South Africa. Better growth, foreign investors looking at us, we're not a failed state. Yes, one should have money offshore. But that's an argument about diversification. It should not be an argument about what you think the rand will do. Bottom line is, despite all the negatives, if we look through the noise and we see the perspective, there's some improvement coming over the next few years. No, we're not a failed state.